The following podcast was recorded on Wednesday, September 15th, 2021, featuring Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to Talking Data. I'm Kristen Radosh of Arbor Research and Trading, joined today by Jim Bianco of Bianco Research and Ben Breitholtz of Arbor Data Science. Welcome to both of you. Team Transitory has won the battle, but hasn't won the inflation war. Jim, we're going to get started with you. What's the latest on reopening versus non-opening CPI components?
Yeah, so when we talk about transitory, I know what everybody means is that the CPI report came in below expectations. So therefore, Team Transitory won. Thank you very much. Drive home safely. But let's try and take this another step further down. Bloomberg has done a breakdown of reopening items versus non-reopening items. Now, admittedly, you can get into a big debate as to what reopening items are. But I think at the end of the day, after we're done taking used cars in or out of the index or something like that, you're going to get largely the same kind of answer. Maybe one version or one basket of reopening will be more extreme than the other. So what you're looking at is a chart here is where Bloomberg broke down the CPI index into three broad categories: energy as a separate category, reopening items, and then you could see underneath it on the little table on the chart is the reopening items. That's about 14% of the index. The other 78% of the index is non-reopening items. And so if you look at the red bar, the last red bar, that's negative 0.22. So the reopening items or the transitory items fell 0.2%. The non-reopening items are up 3.6%, 0.36%. And then the rest of it is energy as well too. If you go to the next chart, what the next chart shows is the same thing on a yearly basis. So we've got 5.2% inflation, of which only 1.6% or so is transitory. The other nearly 3.5% is non or persistent or non-reopening and energy as well too. So this is a big part of it. If we go to the third chart here on the list, what this shows is the non-reopening components, okay? So let's get away from transitory. Let's look at persistent. It seems to be trending higher. Again, you know, that trend might be more or less depending on the basket you have, but I think that the basic shape would hold still. And then the final chart is, if you look at the reopening components alone, they fell in August. The September report that came out in August, or the August report that came out in September, said it right there. And so that you could see that really what happened during the month was that the non-reopening components of CPI continued to show strength, with the reopening parts of CPI fell. And then the last chart I'll throw in, and I'll toss it over to Ben, is the next chart, and that's expectations for inflation. The New York Fed put out their survey this week of 3-year ahead expectations for inflation. The survey was only started in 2012, and this is the highest that it's ever been, and it continues to move higher. So more and more the public is starting to see that inflation as well too. So yes, you could say that the transitory items deflated, like even Ben and I have talked about on this podcast. But when you peel back from that, you can see that some of the non-transitory components or persistent components are continuing to show strength. Leading that charge, by the way, the biggest part of that non-reopening component or persistent components is shelter, OER, and rents of primary residence.
Yeah, it was a report for everybody, like we've been talking about. You know, both sides certainly could, say Team Transitory one, the other, persistent one. But the fact of the matter is, I think what you just brought up, Jim, with the expectations, and I've been trying to almost explain this away, which I hate having that bias to try to do it, saying, oh, the consumer just is chasing the news cycle. But that's fine. If they're doing that, that means that maybe we're getting a little bit of unanchored inflation expectations, and that's changing potentially their behavior. And we'll do so going forward. And that becomes more and more the classic definition of inflation, even though I don't like, admitting that, but that seems to be, more and more the case across. And this isn't just, this survey, this is also the UMich survey, it's in the Conference Board. We're seeing it NFIB, small businesses. So this is getting more ingrained than I kind of ever thought it would. Now,
Can I jump in and ask you a question about that? Okay, remember Dan Torillo gave a speech in 2017 that says we have no real theory on inflation. So the expectations for inflation are rising. So it's becoming a little unanchored by that definition. So what? Is that definitely mean that we're going to get more inflation? Does that definitely mean that people are now more willing to raise prices? It's a theory that the Fed uses. Maybe it's right, maybe it's wrong. Do you have any thoughts on that?
Yeah, no, I think that there's no doubt that it's a cycle. And obviously, we saw it in the 1970s, it becomes a vicious cycle. We're not going to likely go through that at all. But it is, if it starts to alter consumer behavior, and it does either in two ways. Either it gets them to retreat, which we've seen, for example, beginning in housing, especially with the University of Michigan Consumer Sentiment Survey saying that it's just a horrible time to buy. But at the same time, too, it can lead to some activity where, people are fearful of higher prices. So they just, they keep buying because they think it'll be better now than it will be later. And maybe we'll start to see some of that as we push forward. Some things that I've been concerned about on this front is in the supply chain. And like we've shown in the past, when you get supplier delivery times to peak, like they pretty much have this summer, typically it takes about 10 months or so for that to mean revert. Well, what if that isn't the case this time? What if it takes much longer? And there's things like flatbed trucking rates that looked like they were going to just precipitously drop back down to the $2 to $2.50 range. And now they've kind of rebounded and they're kind of stuck, above $2.90. And that's going to mean that everything that we get delivered to us is going to be that much more expensive as we move forward. And I think consumers are understanding that. And the more that happens, the more that we do get unanchored inflation expectations and feeds into a regime shift. And really, inflation is as much a psychology thing too, in terms of how we react to it than anything else. And so I think the Fed's kind of right about that to a certain extent, and we'll see how that feeds into the persistence of it. And
I agree with you. I agree with you.
And I think the big thing too is, do we get a regime shift higher, which we'll talk about in a second. But one thing I'll say too, to kind of go on the heels of what Jim just said about the reopening, prices retreating. Well, what happens now if consumers do actually rebound? And we got this non-reopening component up 35 basis points, which is based on Jim's chart, very, a solid number. What if reopening comes back? And there's some indications that's going to happen. With the Delta variant potentially peaking, we have seen consumer search activity, which are showing here for a whole host of staying in and going out topics, rebounding. Consumer mobility, as measured by Google, is doing the same exact thing into September. So if we come back to some of these travel related, which we have another chart on the next slide, travel related things like car rentals, hotels, flights, and so on, that could keep some of the pressure there and not necessarily allow the complete release of that pricing. And that means, again, we have a little bit more inflation than expected. So, for me, I think I agree with you, Jim. It seems like, the report showed that there was, weakness on the headline number, but there's some indications inside of it that maybe, there is some persistence here, more persistence than people realize. And so we got to see how that plays out here. The bottom line is, like we've been talking about, Jim, since the beginning of this, no one knows. We're not going to know the answer to this until early next year. So we've got a lot of talking about this to do still.
Exactly.
Well, Ben, next, why don't you answer the question for us? Are commodities and yields destined to enter trading ranges?
This is the conundrum, and this is what has got, I think, most people that watch investment markets confused, because you have things like commodities and in particular inflation expectations going nowhere. So really, inflation expectations, if you look at five-year forwards, or if you look at TIPS break-evens, really since April, May, we've been stuck in this horrific trading range, with most, it seemingly, siding with Team Transitory and unwilling to price in this 2.5+% headline inflation that we think is seemingly becoming more and more possible based on this more realized data. But if you look back historically at global rebounds, what we've kind of entered with these trading ranges is very typical. And so here we have commodities. This is looking back since 1960 at all major global rebounds. We're using OECD composite leading indicators to define this. Start 6 months before that recovery is marked. And you can see at this point in the recovery, typically we get these nasty trading ranges, and commodities have begun that. We've seen a decoupling, we've seen a lack of correlation, we've seen dispersion, and so on. On the next charts, we show the same thing, but for US 10-year yields and US 10-year TIPS break-evens. It's uncanny how similar markets have traded relative to past global recoveries. We all say this thing is so different, this pandemic and so on, and it ultimately probably will be, but in terms of how markets reacted, they're kind of following the same script they always have. Now, is that good or bad? I don't know. At some point, this will break down, but what it projects, if this continues, is one heck of a boring slog into year end, where yields grind sideways, we stay in trading ranges, TIPS break evens grind sideways, we stay in trading ranges, and they're unwilling to price in that 2.5% inflation. Now, like Jim and I have always said, the outlook and kind of the wild volatility that we still could see in inflation numbers over the year ahead is, yeah, it's going to move things, but the most important thing is where do we end up in 2023? That glide path, where does terminal rate for core inflation? And we might not get actual market movement until investors feel comfortable that they believe, okay, yes, core inflation is going to glide to 2.5% and stay there, or is it going to glide back below 2%? If that's the case, then all these charts, the market's proved right. But if that isn't the case, then we've got something completely different to expect in early 2022.
The pandemic might have changed a lot of trends in the economy, but it doesn't change human behavior and it doesn't change human emotion. And I think, when you talk about that this stuff is going sideways, it's the general impatience of everybody in financial markets. You make a statement, inflation is going to be persistent or inflation is going to be transitory. They expect that to be reflected in the markets in the next 12 seconds. And if it isn't, then they come out and say, either you're wrong or it doesn't matter. And I think that that's really where this is going. And part of the reason why, when you look at like the B of A survey, that the majority of people think that it's transitory, although Ben and I've talked about this offline, that there's probably a problem with the way that they're doing the survey, because they ask if it's transitory or permanent. There's nothing permanent except death and taxes. So maybe they should ask if it's transitory or persistent, and I think they'd get a little different answer, but I digress. I think that the answer, though, is that people are looking for the markets to reflect this. If inflation is persistent, then yields must go up now. If inflation is transitory, then yields must go down now. And they get this general impatience, and I think, Ben, you're right, that in a typical market reaction, we get a reaction. Look, we went from 50 basis points to 1.8 in March, and then we get a long sideways slog. Frustrates everybody, because neither you're right or you're wrong, depending on your position. You just kind of keeps grinding away sideways, waiting for a resolution, and we keep telling ourselves stories. So a lot of times, really what it comes down to is people need to have patience, but in financial markets, they often don't have patience.
So Jim, what is your outlook for growth and tapering?
So I do want to talk about, combine this story with the story of growth. So if you look at the first chart that I've thrown up here, these are Bloomberg surveys of the outlook for GDP. Think of this as just a big metric for how the economy is perceived to be going. So the first one is for all of 2021. The orange dots are the Fed's quarterly forecasts for GDP. They've been consistently above the blue line, which is which is a rolling update of market expectations. The Fed will give us another orange dot a week from today, next Wednesday, at their FOMC meeting. The idea that we were going to have the fastest growth since 1984, which was a big talking point in the summer, and it still might turn out to be that, is starting to wane because you see that we're starting to fall quite a bit. And if you go to the next chart just shows you third quarter estimates. The last couple of weeks, it's taken a big hit. It's gone from 7.6% to under 5%. Now, yes, 5% is still big growth, but it's going in the wrong direction real fast as well, too. And what this is signifying is there is a perception that the economy is not as strong as people think, especially in the third quarter. That is probably Delta driven. And I also think that that is leading into some of the reopening components of CPI. The one example I'll give is airline tickets fell 9% annualized. What also happened in August was the TSA numbers showed that the number of the people that went through airports fell a lot too. I think that might have been Delta inspired. There's probably some seasonality in there too, that August, especially second half of August, tends to be a slower time of year to airline travel. But nevertheless, I think that there was probably a sapping of demand as well too in those numbers. So really, when we look at the inflation numbers, and especially the reopening inflation numbers, they might also be reflecting some slowing in the economy. Caveat here, we're not talking about recession, we're not talking about calamity, we're talking about going from a very high level of growth to kind of a medium level of growth, but definitely decelerating.
Yeah, I think that's spot on. I think it's hard to ignore the fact of what Delta has done here. And for me here, it's, fine, this quarter is almost a written story already. We only have, half of a month left. And so now we need to look to Q4. So we're going to get a less than expected growth rate in Q3. Now, if we can indeed get Delta to peak and roll over, which it seemingly is, I don't want to put my neck out there on that, but if it seemingly does, hopefully that means Q4 will be looking up. Now, the only issue is we have going into Q4 is the holidays and this complete supply chain mess. We're all starting to buy Christmas gifts way too early in the year just because we're afraid we won't be able to get them, or they'll just get that much more expensive, which again is another psychological sign of inflation. So, I think we have to watch a lot of this alternative data that we've always watched, like Jim is with TSA checkpoints, maybe even the resilience in open table, if that comes back. Some of the search activity that we watch on a granular basis says it should start to come back. I'm with Jim. We don't see recessionary or dire situation, but we're all priced for a pretty hefty rebound in the market post-pandemic, and you can see that in the Citigroup's economic surprise index. With that sinking, economists were all bulled up, and we've just been missing those expectations again, thanks to Delta and the supply chain. So let's see how things go moving forward. I think it's going to be better. That's why I continue to think that this range trade, yields won't fall much further than they have already, and they'll rise. I think there'll be some opportunities still in TIPS break-evens at range lows at levels like 210 to 215, for 10-year TIPS break-evens. And I think there's an opportunity potentially for cyclicals versus defensives to have some kind of, moderate rebound. Now, I don't think it's going to go gangbusters. I still think stocks themselves could enter a trading range like everything else, but we'll have to wait and see.
Let me conclude with a comment about the Fed. Remember that last year the Fed, back up in 2019 they had their Fed Listens tour, and then in 2020, last summer, they announced kind of a subtle change in their mandates, that they're going to focus more on on employment, a little less so on inflation, willing to let the economy run hot in order to get people back to work. Probably the most important statistic to the Federal Reserve at this point is the 6 million people that still have not gotten their job back, that had a job pre-pandemic. They want to see 5, 6, 7, 800,000 jobs consistently every month because that will still take another year and a half to get all those people reemployed by that metric. If we start to see 200,000-300,000 jobs a month like we saw in August, yes, pre-pandemic, 200,000-300,000 jobs is a good number, but according to the Federal Reserve's thinking is, man, that's going to take 3 years, 4 years to get everybody reemployed. Maybe we got to rethink the taper. Maybe we got to rethink about when we're going to start to raise rates. So a slowing of the economy from fast to medium might be enough to get us to have a discussion later this fall about when the taper is going to start, because they're so hyper-focused on the employment aspect of getting everybody back to work and willing to tolerate a little bit more inflation. So that's why when you look at these charts, you could roll your eyes and go, oh, it's not 7% growth, it's 6% growth, and 6% growth is still huge. Yes, but it's falling, and the Fed wants huge numbers to get everybody back to work. And if they don't, they might continue to stimulate.
Well, thank you, Jim and Ben, for your thoughts today. Thank you, everyone, for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our two most prominent offerings are Bianco Research and Arbor Data Science. Have a great day.